Good afternoon, traders and investors from around the world. Josh here, still filling in for Joel for a couple more days. Today we'll have on Rob Friesen, founder of MyStockOdds.com and COO of Bright Trading. But before we get on, Rob, let's take a look at the futures here. So we were down a little bit after yesterday, but we're back up again today. I mean, we can see kind of a tight trading range here. This last week, we've been bouncing between 43.05 and 42.65. So those are the current two levels that I'm looking at. If it breaks above that or breaks below that, well, there may be some trades. I'll tell you that. But anyway, we're sitting up about 0.5%, currently at 42.96. Let's take a look at the dollar. That's currently down about 0.7% at 103.30. Quite a quite a nice consistent down trend. That's a high signal, low noise, we like to say. But we're kind of right at this low of, I believe that's Friday at 103.34. So be watching that level there. The bonds, those are up just about by 1%, going the opposite way of the dollar, currently sitting at 127.18. Crude, after its update yesterday, we're back down, although not as much as we were earlier. We're currently sitting down at just about 2% at 71.22. We're gonna wait for this this daily chart to load, see if we can get some levels. Hey, there we go. Yeah, you can really see that candle going all the way down. We didn't quite get to last week's low, but yeah, still sitting down on the day there. So going to be watching that. Gold, that's up 1%, currently sitting at 1978, still trading under that 2000 handle. Can kind of see also, I mean, gold doesn't trade in a huge range, but you can see we're in a little bit of a range this last week as well. Silver is having a good day, up about 3.5% at 24.35. And then Bitcoin, that's up about 0.16% at $26,530. And let's see here. Do we have on Rob? I
Hey,
believe he's just getting. Hey, there we go. There. How you doing today, Rob?
too bad. Thanks.
Nice. So I guess before we get going, you have a webinar, I guess Stock Odds has a webinar next Thursday. The link for that is in the description. And so the webinar, I believe you're trying to show people how to use leverage and how they can access more capital. I know you focus on a lot of bigger strategies that require a lot lot of capital. So what, tell us a little bit
Well,
about what you're going to be talking about today.
I originally left sort of retail. I was trading penny stocks and stuff like that before I found Bright. So Bright Trading has been that vehicle for many people to use for access to leverage and so on. What we wanted to do with this webinar, though, is we're introducing the topics of how to use leverage safely, more safely. I mean, you can never guarantee anything, of course, but sort of still being fairly risk averse. And one key to that is not unduly concentrate capital into one idea. I mean, that's typically how people have been hurt in pairs. They've been hurt in swing trading or just almost any strategy. It's that bulls and bears can get rewarded and pigs get slaughtered concept, right? When you kind of load up, right? So how to use it,
That's true.
more strategically, more wisely across multiple strategies, multiple time frames, things like that. So it's really about introducing that. It is a free webinar, as we mentioned, and we're also going to introduce this other opportunity for you to use leverage, and it's not connected with Bright Trading. So this is an introduction to an opportunity that could be very appealing for people, because we typically get people wanting to do more strategies and wanting to use stock odds, to their advantage, but they feel like, hey, I don't have enough capital to do all what I want to do. So
Right.
this is an opportunity to, introduce where to get that.
Yeah, cool. Well, that sounds like you won't want to miss that one. I know I'll be tuning in there next week. So anyway, so I heard otherwise you had some reversals to talk about today. What's your approach for, reversals in the market?
Well, I mean, you hear a lot of topics like, rotation. People don't necessarily leave the market. They kind of rotate from one category to another. Some of it can be gaming, some of it can be just trading, some of it can be bona fide investors looking for, where they can deploy capital. So example would have been, I can share my screen here
Sure.
if you don't mind.
Yeah, sure. You can take on over there.
Let's try that. Let's try this here. See if you see that. Just put up
Yep.
the diamonds there as a example of this. So who typically invests in the Dow blue chip stocks? So you have a certain class of investors. You have a lot of institutional stuff. You have some stock buyback programs working on a corporate level. So a very different market participant than you would have in small, tiny biotechs that, are very speculative or something like that. Would you agree with that? You have a different class of investors, different market participants, right?
Oh yeah,
So,
typically between blue chip and
yeah.
small chip and all that. Yeah.
So, so while the debt ceiling thing was going on and we were looking for a resolve that was quite, um, I know, just kind of that wait and see game. You can see it kind of channeling there. And then with the final, passing the Senate, that's when it kicked in. So that's why Friday you had that big move. It's like, now we can deploy capital. We were waiting. That same mentality of wait and see doesn't necessarily apply to micro caps and mid caps and things like that, and meme trades and all the other things that go on. Right. So so you see, so you could call that rotation, or you could call it just wait. This is like, we're going to deploy capital now that that's behind us. Okay.
Okay.
Going into the Qs, I mean, and not only that, we know that the diamonds have been lagging so far this year compared to the Qs, right? So there hasn't been the same level of participation. Now, the Dow did a lot better last year than the Qs did, but we've seen this performance driven by mostly the mega caps and the communication area. Meta coming back, Google performing pretty well. We've seen Tesla in the discretionary area doing well for a while. So this year, you can see since the beginning of the year, not that that was the low. The low was actually October 13th on the CPI numbers, but since the beginning of the year, we've just had a nice smooth path of performance here in the Qs, right? So
Mhm.
yesterday, it dropped, and today it reversed a little bit and headed back up. Okay, so we have an inside day today, and it retraced about 2 fibs of yesterday's move, just past the 50% retracement mark.
Yep.
So that's the Qs. Let's look at the SPY. SPY has obviously some tech in there, some relationship with the Qs and stuff, but it's still been behind the performance of the Qs so far this year. And so a little bit of what happened with the Dow on Friday also happened with the SPY, right?
Hmm.
But it kicked in a little even better this week on Monday. And then you have the IWM, which represents the Russell 2000. And that's been really lagging this year so far. And strangely enough, it didn't really participate in the best 6 months of the year for it. So it was kind of on the sidelines. And that what the small caps have been waiting for is this sort of, is there growth potential? See, growth, right? That's what
Okay.
they're
Yep.
really looking for. And also stability in the regional banks and stuff. And, yesterday
Hmm.
we had KRE was up like it was the day before. Today, things pulled back a little bit. But there's a common mistake that people tend to make in trading, and that is they overweight what is happening too highly, not allowing for reversals. And this can happen pre-market as well as during, looking at it from a daily concept as well, right? It can happen in a pre-market for your trading day, but also can happen uh, on just looking at daily. So you'd have expected like momentum traders and stuff to go, well, look at that. First, we broke out, right?
Hmm.
We punched through sort of this 2 month high. We had an inside day, and then we expanded from that, and so we're off to the races, and we're going right back up here to the February high. So that would be the natural tendency for the human to say,
Hmm. Get
hey,
caught up in the excitement. Yeah.
well, you do, and that's why bubbles are formed. That's why, we had such moves with the AI stuff, and you're going to get conjecture on both sides, like, things are going to go back down or things are going to go up. I don't know. We don't know the future. I do know that in general, we have some good tailwinds. We call it beta tailwinds for this whole concept of, incorporating AI. Let me give you an example. So it might take a content writer, a number of days to produce an article. Using, Chat GPT and some of the other tools, you might be able to cut that in half. So right away, you have 100% increase in productivity. Now, I'm not saying that,
Hmm.
people have tested me on this before. Is this Chat GPT or is this a human? I go, that's human. That's Chat G. You can tell, you can
Yeah, you can kind of
recognize
tell. Yeah.
you can recognize if you use the tool what it's doing. But my point is, people throughout a lot of industries and a lot of tech companies and stuff could see productivity increases. If that's the case, then there's a case for laying off more people. There's a case for better margins, better net profits, better returns, right? So I think that we have to acknowledge why, especially the Qs have been performing so well. Part of it was the January effect, the redeployment of capital after tax loss selling
It,
in December. So
yep.
part of it's that, part of it's what's going on in this AI revolution. And, that could ultimately translate into a large bubble too. But let's not just focus on that and sort of, refrain from using it or being involved. We should be in the crowd of people that become more and more involved and really utilizing the tools as best we can, right? So let's think about how that can benefit not just the tech area but so many other industries. Now let me shift a little bit here to looking at an example. And this was from our write-up the other day here on what happens with the lists and stuff, and
Hmm.
what happens with the pre-market thing. So we've made a bit of a shift. I don't know if you've brought this up on the show before, but we're producing a neutral list of the S&P 500 or 1500 opportunities. So a little bit broader than just the S&P 500. We needed more symbols to be able to do that, to curate properly. So S&P 1500, volume cutoff about 800,000 average volume. Price cutoff for now, $15. So that's not going to bring in some of these $5 opportunities or $10 opportunities. That's sort of a special class. But S&P 1500, from that, a neutral list, which means one long and one short in the same sector generally. There might be an odd case where it's not paired off completely. So not the same industry, but the same sector, right?
Hmm.
Then we have a risk on list, which is exposed more to technology, communications, and discretionary on the long side. And on the short side, it would be the other sectors like staples and healthcare and industrials and so on.
Hmm.
What
So,
can
well,
be
so
what
when you say risk on, I've heard you talk about this before. You kind of come into the day and you determine, hey, is it a risk on day or risk off day or something like that? What are a couple of the things that you're looking for in the morning?
well,
Uh,
do you remember the podcast on Sunday? What Dave and I said about where I expected the VIX to go to? Do you
I
remember?
can't I can't remember what you said about that, but
Well, I'm
why
just
don't you
auditing whether you
share?
actually listened to it or not.
There you go. That was the test.
I caught you. Anyway, I basically said that the VIX has been pulling back, and now that we're past the debt ceiling thing and stuff, there's other concerns, but I would expect that we would be dropping to the 15 level on the VIX, and
Okay.
so we are, and so the VIX is a very important indicator for what the fear gauge is out there. Like what are people kind of doing? See, it's in one sense, it's a problem that we have in the world, which is all these parties using other people's money for, gambling in the stock market, investing in the stock market. Look at all the hedge funds, look at the fund of funds, look at all this stuff, right? Other people's money is being utilized. So that's
Hmm.
that's kind of a problem. But also they have a problem, and that is they need to protect that. So they use options. So when they purchase the puts and so on, it does cause volatility to rise, or when they're not, it causes volatility to drop. Okay. So you
Hmm.
want to protect the money that you manage. That's why you
Right.
have some of these tools out there. Okay. Um, so there's a lot of hedging that goes on and so on. So when we don't see that fear, the sentiment is probably leaning more bullish. When we see fear, it's going to be leaning more bearish. And therefore, just to give you an example, discretionary or cyclical is more risk on. Like I can take risk, I can buy these things. The world's going to be fine, economy's going to be fine, people are going to still spend, whatever. And
Hmm.
consumer staples is like more defensive, where maybe people can only afford the basics. They still have to use those. It's like, you can't do without your, you know, milk and bread kind of thing. I mean, that's what, the consumer staple side of it is defensive. So on any given day, if you could read the market correctly, going long discretionary and short staples would give you risk on. Reversing that would give you risk off. So that's it in a nutshell.
Okay.
So
Yeah.
VIX is an important leading indicator for that.
Yeah.
Also, the US dollar.
Oh,
How is it performing? Right?
yeah.
How about the bonds and the yields? Right? So if TLT is dropping, that means yields are rising. If TLT, the 20-year bond ETF, is rallying, that means yields are declining. So that can be an important decision as well. You can also look at what sort of happened in Asia, what's happening in Europe as context. You can also look at how we arrived at this morning. Was it after a big expanded range session and now we're opening kind of near the pivot, kind of inside day potentially? That's going to change things as well. So here's the thing. I've got the lists here for today. Well, first, let me show what's on the screen here. This was from the other day. So I just want to show that PreMarket. So these were the overnight changes. So you would have seen some of that in the PreMarket if the volume was there, which in the market ETFs is certainly there. Not always does every one of these show, significant volume, but they're sector ETFs. So mostly there's indications there. You can see where it's trading on ARCA and, what it's been from the day before, the net change.
Mhm.
So interestingly enough, these were all showing down and they all moved up for the day. The one that was down the most, IWM, moved up the most. And that was, the regional banks were on fire that day. Okay.
Mhm.
Um,
Yeah, well, yeah, it seems like nearly every one of these
well,
had a
except
reversal
for,
there, except for real estate. Yeah.
yeah. So real estate was, almost unchanged and went up slightly. But here's another case of this was this was down the most, XLE, and it went up the most here, besides IWM. So on the sector ETFs, everyone except XLRE reversed. So that's part of it. You can have either continuation. So what you see pre-market could continue, or you could see reversals. Now, we hope over time to give you more insights and more education surrounding this. I can't solve that for you in this short broadcast, but there is some indications of whether it will be a continuation type event for the day or whether it will be reversing. Okay.
Mhm.
Generally speaking, if you just crop out the most discounted or the most at premium and just focus on the stuff in the middle, you'll be a lot safer for, in case of getting that wrong. But if you went, like, if energy was down the most, do you really want to sell energy stocks that are already down 3%, 4%, 5%? That could be a reversal situation that would bite you. Do you really want to buy gold stocks when gold's up 5%, 6%, 7% pre-market? Do you really want to buy gold stocks? Could be a reversal. All I'm saying is the stuff in the middle is going to be more forgiving. The stuff at the extremities is going to be either you're really right or you're really wrong. Okay.
Right. Yeah.
So here's the thing. We have three lists. This was the neutral list today. And so interesting difference is the larger market caps were actually on the long side. So it wasn't curated by market cap. Okay. The algorithm did not produce these by using market cap. The net outcome of it looking for odds and average performance was actually that it took advantage of the IWM type moves in small caps and mid caps, and it brought in some of these shorts that are smaller in market cap than the longs because of the excessive move that they had. And this is where that contrarian takeaway comes into play, why momentum traders often get it really wrong is because they expect strength to beget strength, right?
Right.
They
Yeah.
expect weakness to continue with weakness, and they get it wrong. Now, it can happen, but I'm saying there's way too much of that in the marketplace. As far as what I've experienced working with retail traders, is they always expect that what is happening is going to continue to happen. So you would have
Mhm.
come in betting today, you would have bet today that Russell would really rock and roll after the last 2 days, and you would have got it wrong. Stock odds is just looking at things statistically, and so it doesn't have that bias that a human has. Okay. It's just looking
Right.
at it statistically. Now, it could be wrong too, which is why we're producing the three lists for you to make a decision. So the more education that you receive, the better you'll be at deciding which to use. So this was the risk, or this was the neutral list. You can see a cyclical long, a cyclical short, defensive long,
Yeah.
defensive
Pretty
short.
balanced.
Right.
Yeah.
It's pretty balanced. It won't be perfect because there's 11 sectors and we're doing 10 longs and 10 shorts. So once in a while there'll be something out of whack. Okay. Also, there could be, sometimes it's really hard for the algo to get 10 that meet the criteria. It could be 7 or 6 or 8 or 9. If that's the case, you have a choice either to run the list as is, or you could substitute the missing amount of symbols with the SPY. So just the amount of capital that you need. That's, again, your choice. Okay. So we'll say up to 10 by 10, up to.
Right.
Won't always be the case. So here's the risk on list. You can see that it's got communication services, 2 of them, consumer cyclical, 4 and technology 4. On the short side, it has consumer defensive 3 and then healthcare is 2 and industrials are 5.
I
So
see.
that's
Yeah,
a
so you're
risk.
really playing those sectors against each other there. Yeah.
That's the key. But the thing is, if you try to do this just by using a screening method to say, oh, well, I don't need stock odds, I'll just go and grab those sectors and do that. How do you know which symbols? What are you going to do? Go through 100 charts, right? You're going to go through 200, 300 charts and figure out what's going to happen tomorrow. You're going to look at fundamental. I mean, it's really challenging to figure out which stocks in healthcare you should use, which stocks in consumer cyclical you could use. That's why using the web screener or the API from Stock Odds can help you actually focus on the ones that have an advantage through lots of samples. Many of these would have had a statistical sample base of well over 15, 20, 25, 30. And so there's enough evidence that when it does this, subsequently it does that. Okay. So that's the risk on list, which means that you are betting that these groups are going to outperform these groups. Okay. Now, risk off has different symbols. Okay. So these symbols are consumer defensive long. And again, they're different than these. We're not taking these consumer defensive shorts and then reversing them. That's not the case here. It's not taking these 3 symbols and reversing it for this list. These are completely different symbols.
Yeah, the sectors are flipped, but the
sectors are flipped, but the symbols are unique. Okay. Where it could be a bit of overlap is the neutral might contain something from the other ones, but in terms of risk on and risk off, they should be unique symbols. Okay. So consumer defensive, there's the longs. We got 3 healthcares and 3 industrials. So that's pretty good spread out there. And then on the short side, communications, cyclical, technology. Okay. Now here's what happened. This is a midday snapshot, which is interesting to me because, again, it's the S&P 1500. We got 3 lists and how they're performing today. Neutral was up. Risk on was slightly down. I mean, slightly up, not up as much, I should say.
Up, but not as much.
It's down because have you ever done that? Have you ever, like, you were profitable in your trading, you take a trade and you lose on that one trade and now you think you're down, but even though you're still up. Have you ever had that experience?
Yeah, definitely. Like, wait a second.
it's a negative mentality. Anyway, this isn't down, it's just not up as much. And then the risk off list, which is defensive, was up the most. Okay, so coming into today, could you have dialed in? What do you think your degree of success would have been from everything, considering yesterday's context, coming in overnight, looking at things this morning, choosing the risk off list, the more defensive? Would that have been your posture or more risk on from what you saw?
From well, I mean, I want to say risk off. Hindsight being 2020. But this morning with I mean, kind of taking into consideration just this past week and a bit of rotation going on, I want to say I might have chosen risk off this morning.
Or risk on, you mean, or risk off? Risk off?
Risk off, yeah.
Okay. So, I mean, I think on the back of sort of, Australia and Canada raising interest rates, that kind of sent a bit of shock waves through. And we saw some dollar response, we saw some bonds response, things like that. So, there was something in the cards as far as, taking a little bit of a pause to what we've experienced. So that's there to some degree. And here's the beautiful thing. When you don't have a read, then do the neutral, right? If you don't have any information, see, this is the whole thing that we want to communicate. And also, this allows us to teach a lot more about what is kind of going on with what you brought up, Josh, which is rotation. With the kind of signals and ingredients that go into any given day, how things move, right? So this provides a little bit more because we're in the same market. So it's a little bit different. It's been harder publishing a Russell list, a NASDAQ list, and an S&P 500 list. It's been harder to communicate because often the Russell marches at the beat of a different drummer entirely than the other ones.
Yeah.
And so,
Yeah.
so you can't
Certainly
really
does.
comment on the market ingredients as well because it's marching to a beat of a totally different drummer. In this case, we can actually talk about what caused the emphasis to be more on these sectors. What are the relationships? What is the context? What are the catalysts? What's the macro? What's the sentiment? So I think it provides a better educational foundation for us going forward by having this type of construct. So
Right.
that's what I'm
Yeah,
excited for.
yeah, it seems that way. Well, we actually just closed as of 2 minutes ago. If you're paying attention to the S&P futures, we closed just under 4,300 at 42.97, and we got a little retreat after the close there. But before I let you go, Rob, earlier in the broadcast, we were talking about Tesla in the chat. That's up just about 5% today. So just to touch on looking for reversals. I mean, this has been a pretty steady uptrend the last couple of weeks. What would
there's a difference
cause you
between.
to say there's
Oh,
a reversal? Yeah.
sorry. There's a little bit of difference in the signal to noise ratio on Tesla versus sort of this gap and really get stretched out on any given day, or you have another day where you gap up and then you pull back. So Tesla's been very strong on the signal to noise side. So I wouldn't say that this is a candidate where you just go automatically assuming it's going to pull back, right? So there has to be context to reversals too. And it's a little bit different in the market than in an individual stock. So an individual stock could streak for 14 days in a row, but that doesn't mean a market ETF like IWM or the Dow, DIA, Diamonds, or the SPY is going to streak for 14 days in a row. Completely different animal because the ETF is already statistically muted. So the fact that it's going to get overbought or oversold much easier than an individual stock that might have a catalyst on it specifically. I mean, you can look historically at how often the any market ETF even streaks 7 or 8 days in a row. It's not much. It's not many times that's occurred, right?
Yeah, they're a lot more muted performance.
A lot more
Okay,
like
well,
1 or 2 days up and then 1 day down and then 2 days down and 1 day up, or 3 days in a row. That's more of that. But an individual stock that has a catalyst and it's high signal to noise ratio, I don't automatically assume that it has to reverse. This isn't a mean reverting argument. Now, in a relationship, it could. Put it this way. Say take GM and Ford, and say GM had a short-term catalyst and streaked for 10 days in a row and got really displaced to Ford. There's some argument that Ford's going to go, hey, what are they doing? Let's do that too. There's some argument that it's going to catch up and that relationship is going to stabilize back to more its historic perspective. But if you just pull one stock out by itself, how do you argue for mean reversion if there's a catalyst going on that's supporting that high signal to noise ratio?
Yeah, it's a lot harder to argue against that or to go against that. Well, all right. Well, good stuff, Rob. So tomorrow on the closing print, we're going to have Kenny Glick from Hit the Bid join us, and I'll be hosting that show tomorrow. And then Joel will actually be back again on Monday. So make sure to tune in for that tomorrow. And then Your stock odds webinar, Rob, the link is in description for that. That's next Thursday, I believe, on the 15th. So people can
Well,
sign up for
that'll
that.
be good because that's right after FOMC meeting. You know, we have a 2-day meeting next week. We'll find out what the interest rates decision is. And that'll be good because we'll be post that. We can talk about that a little bit, talk about the strategies and the opportunity to use leverage to what do you call it? Supercharge your returns, supercharge your opportunities.
Yes, it's all about supercharging off. All right. Well, thanks everybody for tuning in. We'll see you tomorrow.
Okay, thanks, Josh.